All right, ladies and gentlemen, so the new bill is out and it's going to be a big difference from how we were filing with taxes before versus right now. This bill changes everything. It's been signed by the president and now we have a new law. The new tax law is going to affect everyone, whether you are a Medicaid recipient, SNAP benefit recipient, whether you are a veteran, whether you are a small business owner, whether you are a low income earner, whether you are a tip earning individual where you're making income through tips. This is going to affect a lot of people, and the details that we're going to cover in this video should help you quite a bit to make important decisions that you need to make before end of the year, so your tax bill reflects what you want it to be. Stick around to this video to understand all the provisions of this bill that are relevant to you. So number one on the list we have is the clean energy credits. Means if you are somebody who was planning to get solar panels or batteries for your house to power your house for electric, you may be in a situation of running out of time, and whether you were thinking to take advantage of the 30% federal tax credit depends on how fast you can execute the installation of solar panels on your residential house. If you are going to shop around now and wait for 2-3 months, you may be running out of time. The deadline is December 31st, 2025. So if you get the solar panels installed before and they are in service before 2025, you still will be eligible for the 30% federal tax credit. But if your solar panels are not online by the end of 2025, December 31st, you're not going to be eligible for the 30% federal tax credit that was available to you from the previous administration policies. That was supposed to phase out in 2032, but that has been now changed to the end of 2025, December 31st. So please keep that date in mind. That's going to make a big difference. If you are going to, if you want to get an estimate on how long it is going to get it for you to get solar panel, if you were on the fence trying to decide whether you want to get solar panels or not, right now would be the best time to call and check around. I am not advocating for installing solar panels for your house, but this is what exact changes that has been made. And you can also check with your accountant if there are any stipulations that apply to you. Obviously you want to check with your accountant on everything. We are just the messenger, we are just interpreting the information as we see, but we also need to make sure that we're checking with our accountant to make sure the information that are given to you from random guy on YouTube are also relevant on your case. Number 3 on the list is the EV tax credit. So if you were thinking to buy electric vehicle, your deadline to get the federal tax credit of $7,500 expires on September the 30th. Make your purchase before that or you will not be able to claim those credits. This is going to hit Tesla, the biggest electric manufacturer in the United States. They're pretty much down 20% since the president came into power. He was always against the mandate of having electric car, which is what is happening now. So they are down 20% right now. I am sure the number is gonna change later on, but as of right now, we can see that these numbers are affecting the deliveries of the electric vehicles also. And since the passage of this bill, time will tell. We will see how things go for Tesla and every other electric manufacturer. But the $7,500 credit on the federal tax return for the new vehicle is going, and also $4,000 credit for the used EVs is also going to expire at the end of September 30th, 2025. So please take a note of that. And if you are planning to purchase one, do that before the deadline is over and take advantage of those tax credits. According to the previous rule, the next one I have on the list is the SALT and the state tax. So if you were somebody who were filing your taxes, federal taxes, jointly as married couple, you were able to take off $10,000 from your federal taxes for the state and local taxes that you pay. And that was the only relief you used to get, and that was even lower for people who were filing married separately, just $5,000. That limit has been exceeded to $40,000 now. So if you are paying your local state taxes that exceeds 40,000, that is between the $40,000, you can take advantage of that new provision. However, it is only capped at $500,000. So if you make less than that, you can take advantage of this provision. If you make more than that, it does not apply to you. This will definitely help individuals in high tax states like California, New York, New Jersey. These states have very high state income taxes, and this can help you offset some of your tax burden on your federal tax bill. This is a good relief for high income earners who make between who make under $500,000. So that's a good one. That's an improvement. That's a relief. The next one is highly controversial and heavily debated topic, and that is Social Security, Medicaid, and SNAP benefit cuts. There is a spending cut of $1 trillion, and this is supposed to save taxpayer around $1 trillion between 2025 and 2035. Going forward, individuals wanting to receive these benefits who are between the age of 17 and 34 are required to prove work requirements of 80 hours a month, around 20 hours a week, and they have to provide this documentation twice a year to be eligible for Medicaid benefits. On top of that, there is going to be these changes are going to take effect starting 2026, and green card holders going to have to wait 5 years to be eligible for these benefits. These benefits are going to affect between 11 and 17 million individuals currently taking advantage of these benefits. And to top it all off, they will also now have an increased copay of between $30 to $35 per visit. And the next one on the list is auto loans. If you're buying a US manufactured vehicle and you are paying interest on it, you may be able to write off the interest of that car payment up to $10,000 if you purchased that vehicle between 2025 and 2028. The stipulations are, if you are a single who are filing your taxes by yourself, then it phases out at $150,000, and you can take full advantage of it up to $100,000. After between $100,000 and $150,000 it starts to go down. You don't get the full benefit, but you do get some of the benefits. If you're filing married jointly, then it phases out at it phases up to $200,000 in income as just a growth income. You're going to be able to take full advantage of it, but at $250,000 you're no longer eligible to receive that $10,000 benefit, in interest payments write off on vehicles that you have bought between 2025 and 2028, and those vehicles got to be US made. Things like vans, cars, passenger vans, trucks, motorcycle, pickup trucks, they're all included. They're all part of it as long as they are US manufactured. All right, let's get into the juicy stuff now. This is for the businesses. If you own a business, you're a freelancer, you're a sole proprietor, this section applies to you. So remember 2017 tax provision that was passed to help small businesses, freelancers, sole proprietors, LLC owners to reduce their tax burden by 20% temporarily. That was set to expire at the end of 2025. Well, that provision now has been extended and made permanent, and it affects a lot of you. There are lots of limitations around who qualifies for it, who does not qualify for it. We'll get into the detail, but the important thing for you right now to remember is those provisions that apply to certain types of business. If you were a business owner, you got those provisions, advantage of those provisions before. Well, now you will continue to take advantage of those provisions, and they are permanent now. So there is no sunset period which was set to expire at the end of 2025. They will not be expiring at the end of 2025 now, and you will be able to deduct 20% off of your net income from your taxes. It does not really affect your overall tax bill or reduces your tax bill, but it takes off 20% of your net income from your business, and you only pay tax on about 80% of the income that you earn from your income. The limits are, it will for single filers, the limit is $191,950, and for married filing jointly, these limits are going to go up to $383,900. This is going to apply to sole proprietors, LLC owners, S corporations. What it will not apply for is C corporations and anybody who is earning W-2 wages. If you are earning W-2 wages and you are also a business owner, then you still get to take advantage of this tax break. A lot of reports suggest that in 2026 these limits have been increased to 23%, but I cannot confirm that or deny that right now. So please stick to just 20% for right now. Check with your accountant. Obviously there are still publications that IRS needs to publish on the website to clarify these things, but they are not available on the website yet. So we are still waiting, just like everybody else. But our initial research suggests that it is 20% all throughout, but it's permanent, so you don't have to worry about them expiring and then all of a sudden your tax bill goes up by 20%. So that's a big relief for small business owners, freelancers, sole proprietors, anybody who's running a small business. It helps quite a bit in making these provisions that they're set to expire at the end of 2025. Now making them permanent makes a big help and big relief for small business owners, and that money is going to eventually circulate in the economy, create more jobs, more expenditure, and eventually help the economy overall. And this deduction is a below the line deduction, means you don't have to provide any type of itemization or expenditures that you did to be able to eligible. And these deductions are not to be itemized, which means you don't have to itemize them, show IRS a list of expenditures. You just take 20% off of your net income, and that's your that's the income that carries forward to your personal taxes. So 20% off your business taxes, and that gets carried over to your personal taxes, and whatever tax bracket you fit in, you pay your taxes based on your income overall as an adjusted gross income. Alright guys, so with that being said, we're going to go over some more provisions that are going to affect your tax bills, and I'm going to go through it quickly. We'll expand on these things later on in another video, but for right now we have these following changes that has taken the effect. The next one on the list is the permanent extension of Tax Cut and Jobs Act. So no changes are going to be happening to your tax rate. It's going to remain the same way they were during the previous administration's tax returns, and they are permanent, so they are going to not expire at the end of 2028. Standard deductions have been made permanent, so you have $1,000 extra standard deduction increase for individuals filing taxes as single, and people who are filing joint, they have been increased to $2,000. Next on the list, we have personal exemptions. No return of exemptions has been deductions, so effective remains repealed forever. The child tax credit have been increased from 2,000 to 2,200. It's been a slight increase, but that has been the new change. Then next up on the list, we have full expensing. So bonus depreciation is back. Investors who are buying up equipment or furniture, real estate, assets in general, they can fully depreciate their asset 100% now, instead of amortizing it over the course of 26 years or 40 years for commercial. R&D expenses, you are able to deduct all your R&D expenses in the very first year instead of amortizing it. So if you have a business, you are spending money in doing R&D, whatever expense you are incurring doing the R&D, you will be able to expense all of that within the very first year that you are spending the money on your business. The next up on the list is going to be the new deduction for wage and tips. So above the line deductions on tips, overtimes up to 25K for income earners up to 150K expires in 2028. So if you are an income earner that makes less than $150,000 and you have a tip income of about $25,000, that $25,000 is going to be tax free going forward until at the end of 2028. Then we have senior bonus depreciation. So temporary 6K deductions is set to expire in 2028, phases out at 150K aggregated gross income, and that phases in at $75,000 annual income. The Trump account for newborns, government deposits 100K on a child that has been born in 2025, but between the year 2025 and 2028, and parents can contribute up to $5,000 per year for the future education, home, or business for the child. Employer paid family medical leaves and credits, so making payments, tax deduction and expenses credits to cover the tuition, student loans within the limits, obviously. Depreciation for the rural opportunity zones, so keeping opportunity zones at the designation, but requires a 33% rural continuous tracking excluded. So these are some of the provisions we covered. There's a lot more in the bill, but this is what is going to affect you directly. Let us know in the comment below which section you are not so clear on. We can expand on this one. Remember, we are not tax professionals. We are small business owners trying to help another small business owner. The information that we have, we are sharing with you to make sure you get something out of our work that we are doing. And if you like our videos and if you like our content, you can hit like and subscribe to our channel and press the notification bell, so whenever updates like this come, you get them first and you get help from it.